Good afternoon, everybody. Welcome to our Short Verticals webcast, where that's all we trade in this class is short verticals. And I know there are a lot of you that would like that particular strategy to be your bread and butter, right? Just kind of your go-to. So we're going to talk through our methodology here. And today I'd like to spend a little bit of time on some questions that some of you have had. There's a couple from the most recent survey that we had, as well as a couple of questions that were left over from last week's session that really still have a lot of application here today. So we're going to make sure we get those questions answered for you. Now, I hope you're following us on X. I am Connie Hill, CS. We have James Boyd in the chat. Yes, the redheads will be taking care of you today. Glad that James is here. I'm going to keep my eye on the chat for any questions I might need to address. James will keep an eye on it as well, in case there's some things that he can help me out with. Now, I told you I was Connie Hill CS. James is James Boyd CS. And just catch up, on that information that we share with you that we think you'll find interesting. Let's go through our disclosures. Let's lay out our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about here today is for information and, and education. Don't consider it a recommendation. We'll be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool as you're practicing strategies, especially short verticals, to just be able to do them in a paper account before you jump over to your live account. Investing involves risk, including the loss of principal. Keep in mind, short options can be assigned at any time up to expiration, regardless of the in-the-money amount. This is something that Paper Money doesn't reflect as accurately as maybe the live market. It will not assign you early, but the live market definitely can assign early, and it does assign early. And so I want to make you aware of that possibility. Past performance of any security or strategy does not guarantee future results or success. All right, upcoming events that are still you can register for. Some of our other events that aren't listed here are booked. You guys have done a great job signing up. I think you're going to enjoy it. But what you want to put on your calendar: Dallas Market Drive event, September 20th, Chicago Market Drive, October 4th, and then Orlando. This will be a workshop, technical analysis and options on October 10th and 11th. So if you can get there easily, it's well worth the effort to do so. All right. This class is more of an intermediate level class where we talk about short verticals, but I know there's lots of you that are familiar with verticals to some extent, and you're really trying to get your bearings in it. You're trying to work on it. So I like to address some educational aspect of short verticals. We always do example trades in here. We're going to follow up on some trades, and we are going to put on some new trades and answer some of those questions. All right, so first of all, let's just get to kind of a teaching point as far as short verticals go. Last week, we worked on stock selection, what kind of stocks you might want to use for this strategy, and we rebuilt our watch list. Hopefully you caught that episode. If you didn't, I will put a link to it in our show notes at the end of our webcast here today. But when we're talking about strike selection, many times people want to sell a put strike, in this case, below a recent support level. And that was actually one of the remaining questions from last week, is do we want to make sure that we're selling on the other side of support? And the answer is, if it's possible, absolutely. Okay, that would be nice and ideal, because you'd have your support level there, and hopefully that would act as a buffer, right? If the stock does come down, maybe hits around your strike area, or maybe what that support area is, that hopefully it'll bounce back up. But targeting, most of the time, people are going to focus between a 30 and a 40 delta. And then the long strike, the one that we buy, that's our hedge lag, typically we'll buy that long strike price a little further out of the money, and it results in a credit to your account. We get paid that credit right when we get into the trade. And that's a little bit different than some strategies, right? If you're, say, trading a long call, you're not going to get paid on it until you sell the call, right? Until you've completed the trade. So it's something that is, I think, for some traders, they might like that ability to get paid right at the beginning of the trade. Typically, we're looking for 20 to 50 days worth of time that we want to sell. Could there be exceptions? Yes, we'll talk about some exceptions today. Sometimes traders will have a minimum return on their investment that they're seeking. Some people might say, okay, for something more conservative, maybe they're looking for at least a 28 or 30% return, 32%, something like that. And then there might be other people that want to gauge it more aggressively. And they might say, hey, I want to get at least 38, 40, 43, 45%. Okay. So you can decide how aggressive you want to be with the strategy and what you don't want. Typically, and we'll do this in this class, position sizing, some traders like to base it on the maximum loss, and that's what we do in our class here. And then this strategy, short put vertical, we want to be bullish on the stock, or at least maybe sideways trending. Maybe the stock has an uptrend, but maybe it's in a period of consolidation, so maybe it's gone a little bit flat there. Those are going to be those that typically are going to have the best opportunities for us. Kelly says, hopefully the 30 delta is above or below support. So hopefully where that 30-ish delta is, we'd love for it, right, to be below that support level. So you can bring in your technical analysis and your probabilities, kind of marry them together, and that's what we'll look at a lot in this class. All right, let's head over to our Thinkorswim. Harry had a question from last week. We're going to address Harry's question as we set up and look at maybe our first trade that we considered. Markets are giving up their gains, right? Microsoft, Meta had fabulous earnings report, gapped up. They're still holding their own, but it really kind of pushed the overall markets into a nice all-time highs opening today on the NASDAQ and the S&P. And now we can see the NASDAQ's giving back a little bit of those gains. Let's see, SPX looks like it is doing the same thing, kind of a big bearish engulfing candle, right? So really gapped up, and then it's been kind of falling, giving back those gains as the day's gone on. But the trend, obviously, it's just barely today making it down to the 10-period moving average. Let's take a look at the volatility index. If the markets are sliding, what do you think is happening on the volatility index? Okay. Yeah, if you said it should be going up, you're right. It should be going up because usually they have that inverse correlation. And so it looks like the VIX is up kind of more than it has been in a long time. So it's up into the 16.7 range, which is still in a lower area. Okay, it's not like it's up at 20, 22, 24. We would be seeing a lot of selling off activity if that were the case, but it is getting a little bump here. Maybe we'll see some increase in the volatility in the markets. When we're going through earnings season, yes, we absolutely seem to have volatility day to day, depending on who reported, what they reported, how good it looked, how good it didn't look. Chris says, if the big bullish engulfing candle on the VIX right now means anything, we might want to sell call spread trades today. And, we could take that approach, Chris. Many times traders will want to be following the same direction a market is going, or an industry or sector might be going, so that they're aligning as many things as they could. But you're right, with a little bit of a pop on a VIX, if somebody wanted to say, hey, I want to be a little bit more aggressive, taking the downside, you'd certainly want to go look for downward trending stocks, those that are weak, those that are struggling. Don't pick on something that's been in an uptrend and just having a little bit of a pullback. Okay, definitely pick on weakness if you're going to be doing that, doing some short call verticals. Now, one of the trades, there's a few trades actually we are going to take a look at that hit their targets last week. Let's start with the first one here. This is NVIDIA. We just did a little short put vertical on it. We did this last week in our class, circled when we got in, and then it ran up for us, continued to run, got out yesterday. Because we said we want to get a chunk of this, we're not going to hold out for every little last penny on it. We took a chunk of it. And so we sold this one. Let's go to our account statement on NVIDIA. Here we go. We brought in initially a credit of 66 cents. We bought it back yesterday. And we had that order sitting there. Thinkorswim just executed it for us. We bought it back for 14 cents. We said we'd be willing to buy it back at 16. So we got a couple extra pennies. That never hurts, right? And so on that trade, we had a net of $52 per contract. We had, how many contracts here? Looks like we had 8 contracts. So that ended up being about 416 bucks. So for a week trade, is that worth it? Do you think that would be worth it to you if you were doing something similar like that in your account? Yeah, we're not looking for big home runs here, but man, these base hits can add up. Let's look at the numbers on this next one here, and then we will look at the chart. By 370, that's going to give us about a 35% return. Now, on this particular one, you might go, well, that's okay. Some of you might have a rule that might not allow you to accept this one. If some of you have a rule that say, I want to get a percent per every day that the option has before it expires, you would be looking at this one at like a 50% return. But if that's not the case, you might go, okay, 35%, I'm good with that. Hopefully we'll get out early. Never guaranteed to get out early, but a lot of our trades we have been able to exit early on. Okay, so some of you might like that, some of you might not. Now, the other one I was eyeing, and I don't know that it's, we'll run the numbers on it. It's going to be a little bit more aggressive. It's going to be this 110, 105, and I've got that set up to blast all so we can do a comparison there. This one, again, is more aggressive. It's bringing in $1.90. Okay, so on this one, $1.90, 5 minus $1.90 should be what? 310, right? If I'm wrong in my math, you guys tell me. So we're willing to risk 310 to make 190. The probability isn't as high. It's only 42% or 54% here. Okay, first one we did is 66. The next one's 54. The return, let's just run the numbers here real quick. 190 divided by 310 gives us a value of a 61% return. Now, I want you guys to vote for you personally. Does one of these feel better to you? Okay, tell me trade number 1 or trade number 2. And it could be that you don't like either of them. It could be that you don't like to be this as aggressive as this. And it could be that you're like, well, I like the percent there, but I wish it was more because we're out 50 days. And these are kind of questions that you're going to run across as you practice this strategy, right? And you want to be able to maybe have some paper examples that you've traded in your paper account, whether it's something like this or something on your own, so you get used to working through those questions. Okay. Okay. Okay, you guys, it's been brought to my attention that we had a little bit of a power outage and you missed a lot of what I was just talking about here. So we're going to, so I'm going to give you a kind of a recap, a quick recap. Okay, we were looking at, for our first example trade, Lennar. Let's go over to the chart here. And we were looking at this ascending triangle. We're going to take the third entry here, which is a bounce off support, right? And I said, okay, let's look at what we possibly have. We looked in the weeklies, there was not a lot of open interest, so we decided not to spend time in there. So let's just go out to our September options. The August 15s have 15 days. That could have been a possibility if somebody feels comfortable going that short, even though it's kind of down, kind of past the range that a lot of traders might look for. And we put on 2 different trades, one more conservative, one more aggressive. We put on a 105-100 with a $1.30 credit, and it was going to give us about a 35% return. The second trade, and I'm having you vote on it. Okay, this is trade 1. This one's trade 2. Trade 2 is more aggressive in that the probability of expiring out of the money is lower, so it doesn't fit in the full 60% or higher that some traders like to use, kind of below that range. We bring in a $1.90, and so it's kind of that teeter-totter, right? If we want a higher probability of success, we typically get a lower return. We want a higher return, we get a lower probability of expiring where we'd like it to. And so this one was giving us a 61% return. And so my choice to you is, which one for you personally do you like better, or do you not like either of them? The reason you might not like trade number 1 is because we've got 50 days before the options expire. And when those options expire, some people like to say, I want to get at least 1% a day for every day left till expiration. So that could be one that you're like, if that is fixed in your rules and you don't want to deviate from that, then you might not pick that one. This one, 190, might not meet some people's rules because of the lower probability of success here at 54%. Now, earlier, the numbers shifted a little bit from the time I ran them. Earlier, both of them were 60+%. But with a little pullback we've had, it being off its highs, this is this value, the 54%, has pulled back from being above 60. Wrong lights, 105-110. Any other votes here? Sri says, so when it pulls back, we know the risk versus the reward, or just in general, you want to know the risk reward, right? You want to make sure that you're comfortable with it, that falls within your rules. Okay. Well, for our purposes here today, we're just going to run one of these trades. Okay. We're going to go, we don't usually go quite this aggressive, but we're going to go a little bit more aggressive today. David says, with 50 days expiration, I would consider the second, but you really don't like either. And that could totally be that you're like, does not meet my rules. Okay. So we're going to get rid of this one. We are going to keep the more aggressive one. We can risk up to $1,500 per trade in our class account that we work with. If we are willing to risk $1,500 and we're okay with the $310 of risk per trade, we could do 4 contracts. Now, the other thing we could do here is say, well, let's not do as many contracts, right? If it's more aggressive, and that could be an approach, we'll go ahead and we're going to do the 4 contracts here. Change this to first trigger sequential. Let's create our opposite order. Let's say if we get a chunk of the 190, let's get out early. Okay, so on our 190, what if we were to get, say, 65% of it? Would you be happy with 65% of a $1.90? Let's see what that would be. If we get 65%, only 35 is left. So we'll multiply that number by 0.35. That says go buy it back at $1.26. And I'm going to rerun that math because I was thinking it might be a little bit higher than that. So let's just try that again, okay? On that. Now I've got to go back here. I apologize. So our 0.35 of our max theoretical gain of 190 is 66 cents. Okay, that's more what I thought it might be closer to, not $1.26. So we're going to go with this one that I think is going to be our accurate number. Could have a leftover calculation in the calculator. So let's go buy it back then. We're going to buy it back at 66 cents. Let's do a good till canceled. And if it makes it early, great. We'll be happy to take the chunk out of it and not try to bleed every little last penny out of it. Okay, guys? Going to hit confirm and send. We're going to put this in our bullish short verticals bucket. All right. Somebody's having a hard time getting that to fill maybe in paper. You may have to, and it didn't fill for me either. It could have changed a little bit. Let's see what it's pricing at. We had set $1.90. Right now it's trading for $1.80. Okay, $1.90 now. We'll see if it gets filled. Okay, if it doesn't by the end of our class, I'll go back and make sure to change it. If we have to drop the price a little bit, that's okay. We don't mind doing that. Yeah. Now Vic says minus 105 plus 110 in terms of the sell and the buy. We actually did two different ones. Okay, so the first one we did was selling 110, buying 105, and then, well, I take that back. The first one we did was selling 105, buying 110. The second one, we just kind of shifted down on the options chain. So we were doing this one here, 115 by 110. Okay, so the last one was 115 by 110. The first one we did was 110 by 105. Okay, so hopefully that gives you the clarification you need. I know you weren't hearing our entire discussion about that. Okay. All right. Let's look at one other one here. PDD Holdings, stock that overall has been in an uptrend, right? We see, man, it had a nice long run up here. In fact, some people might even look at this as maybe a flagpole move, and actually could have started it right there. Could have started it on that bullish candle there. It's going to be about the same. But then right here, we're seeing a little bit, some of my eyes might still see it in the flag consolidation if they were going for the flag pattern. Some might look at it as it's come down to support and it's bouncing at support. Sometimes traders don't mind getting in on something bullish on a spread if it's at support without necessarily waiting for the bounce. Okay, so we're going to get in based on the idea that it's fallen back to a support area that's existing. All right, we're going to hop over to the trade tab. And on this one, we're going to use the August 22s. They have 22 days to options expiration, so it does fit nicely in the 20 to 50 days box, all right? Has a little bit more open interest in strike prices that we might be interested in. So on this one, let's see if this still makes sense to do 110, let's see, 111 and 110 here. Look at those hundreds of open interest there. Makes you feel a little bit comfortable, right? You're not the only one out here trading. There's several contracts out there. So we're going to say sell our vertical. And that actually is a pretty juicy premium here. On this one, selling the 111, it's now at a 38 delta. I think when I was looking at this a little bit earlier here today, I think it's changed a little bit. Let's do this. Let's do our blast all, and let's also line up 110, 109, see if that might make more sense, depending based on where the stock is right now. So maybe not nearly as aggressive. We might feel comfortable not doing quite as many contracts because maybe there's only about 100 contracts-ish out there with the open interest and volume today. You know, we might feel comfortable doing a couple of contracts. We could feel more comfortable doing more contracts with the 111 and the 110. Okay, so again, it's kind of a trade-off that you weigh. Again, we're going to go with a little bit more aggressive one. We're going to go in here, and I'm going to say the swaying point for us right now is the open interest. Okay, now in your rules, if you're like, no, I don't feel comfortable with that, that could be just fine. I do want to come out here and look at if we would be selling below support, right? Because that goes back to one of the questions that we had. So we're kind of looking at 110, 111 here. Let's see where that boundary might be. So 111 is going to be, let me come down a little bit here. All right, that's pretty close. 111's down here. So kind of close to today's low, but we've got about, what, $2.27 of leeway. The 110 would be a little bit lower here. It's a little hard to see that number, but it's going to be, you know, about that area, 110. Okay, so $1 more leeway here, depending on which one you felt more comfortable going with. Okay, now if you're trading in a smaller account and you can only do, say, a contract or two, this might be a little bit more appealing because you have a little bit more flexibility and you're only going to do a couple of contracts. And so you're not worried about the open interest. If you are somebody that likes to trade 20 contracts, 10 contracts at a time, because that fits your size of your account and how you position size, then that might lean you more to doing the 111, 110. Okay. One of the things that I wanted to include in our discussion here were kind of like trade-offs, right? Trade-offs, higher reward versus higher risk and the probabilities that come with that, but also other things that you want to take into consideration, the things that we reviewed in that slide to begin with, which one of those was, making sure we're trading some liquid options so we get tight spreads here. And these are pretty decent. These aren't bad at all. Okay. Chuck saying, yeah, maybe about 108. Chuck says you'd feel a little bit more comfortable going further out in time. Absolutely. There might be some people that do. Just seeing what that other question was. Isaiah wants to know if we're going to do an earnings trade. I'm actually going to avoid earnings today. We've got a lot of earnings. We'll talk about that in our class tomorrow of one trade that went against us on earnings, pretty bad in our trading a smaller account. So it's not always going to be perfect for us, okay? Let's go ahead with this. Let's go a little bit more conservative on this one, okay? And we're not going to do as many contracts. We're going to delete this one. We're going to go with the one that is a lower credit, but still kind of a healthy credit. Gives us a little bit more leeway. So we'd be down here at 110. So we've got $3 and some change of leeway. And we're just going to do 2 contracts here. Okay. The whole of it is not going to be more than $100 of a gain, but sometimes just those little hits and building some consistency can help you. Okay. And we could probably do about 3 contracts here. Let's go 3. We'll do a first trigger sequential. Let's create our opposite order. And in this one, we've got 36 cents. What if we hold out here for, say, 80% of it? And say, okay, if we capture 80%, only 20% is left. So we're going to multiply this by 0.2. Let's get the number in there, times 0.2. And that says buy it back at 7 cents. Okay, so here we go. We're going to just pop that in. 7 cents. We're going to make it a good till cancel. We're going to send it in and on its way. Let's put it in our short bull vertical bucket. All right. Now, Sharon says the prices both 1030 moving averages. Do you feel comfortable to do the short put vertical? Let me go to the chart, Sharon, and see what you're talking about as far as the 10 and the 30. So the blue one is the 10. The 30 is this red one. So it looks like it's fallen below the 10, but it's, I don't know, if I had a 20 in here, maybe it would be similar to something that a 20, but it's not all the way down here to the 30. I would say it's well above that 30 period moving average. Now, I hope all of you have become subscribers to our Trader Talk channel, because when you are, it helps you find our content a lot easier. And YouTube has some nice features to help us out. So with our Trader Talks channel, you'll see some different playlists that we've organized. You can see what's coming up next, which in our case, Think Script Studies. Ben Watson's going to head up that class today, covering for Mike Fairborn. So he'll be up at the top of the hour. Just kind of see what the lineup is, and then Kevin Hoare will be after him. If there's some classes that you want to make sure that you're catching every time, say you're trying to master short verticals, okay, you might want to set an alert for when the class comes up, because maybe you just need that little reminder so you don't miss things. Okay, so that's one way to use it. Another way to use it is basically following the playlist. But I did want to show you something down here, which is a bite-sized content. And this is kind of a newer playlist that we've developed here, where we're looking at really small short videos, less than 10 minutes. Okay, Scott's got a couple of 8-minute videos here. I've got a 3-minute, a 5-minute, 4-minute video. Okay, so they're just kind of little snippets of a procedure or technique or technical analysis that we're sharing with you kind of in a bite size, which we know, sometimes you just don't have all, an hour to go through a technique, you just want the basics, baby, right? Just lay it out the way it is. All right, very good. Let me just come back to our charts here real quickly. Now, I'm going to just bring up a couple of stocks that are on our watch list, okay, that could have something potential that you might find interesting. Let's see if they're still holding up. STX is one. STX is something we've traded in a different class, and that's what this particular trade is. It's for a different class, but what are we seeing here today? Tech moving, some of tech stocks are moving. This stock announced after the close on the 29th, kind of gapped down, but ran up at the end. Now it's sitting up here a little bit higher than where it even was before they announced their earnings. So a nice little bounce entry here, bouncing off the 30 and going above the 10. Some people might like that for a bullish entry. Don't necessarily grab these strike prices. That's for this particular trade. They might not line up right now. And then the other one is that might be interesting. Let's see here. Actually, I wanted to show you this chart too on this one. I wanted to go out to a 5-year chart. What's interesting about this on a 5-year chart, does this not look like a major flagpole? Well, look at the length of that flagpole. It's enormous. It's in a weekly chart. Kind of went horizontal here, flag in a stiff breeze for a few days. And now today it looks like it's breaking out of that consolidation there. Okay, that could be an interesting setup for short verticals or any other type of trade that you might be considering. All right, you guys, my time is up. But we followed up on several of our trades. Some of them hit the targets based on the idea of putting in, to get out when we've got a chunk of it. Some of them, actually the ones that we got out of, that's exactly what happened. We have 3 that are trades of patience. We're just going to let that time decay work in our favor. They haven't made a violation of technical support that we might consider, oh my, that's scary, we better get out. Okay, neither of them had any of that. And then we got a couple of new trades on there. We did Lennar, we did PDD, and kind of talked through some of the variables, which answered somebody else's question about, would it be could we go into a little bit more detail about talking about differences in strike prices and kind of this reward probability trade-off. So thank you so much, everybody. Appreciate you being here. James, thank you for helping out in the chat. I think these guys were fairly nice to you. They did not do too much. I don't see a survey out there today, but if this was helpful to you, hit the like button and follow James and I on our X. And if you haven't subscribed yet, just click on that subscribe button so you can find our content easier. All right, everyone, we'll follow up on these trades next week. We'll see you then. Bye-bye.